Hello traders, Rich here. This video today discusses how a diversified systematic trend trader views price action contained in a time series and explores what we mean by the term a trending price series and the associated surrounds of that term, which is called noise. We are a quantitative mob that simply refer to the clues contained in current and historical price alone that attempt to distill any bias in that time series of price that is deterministic in nature and has the ability to possibly project as an enduring feature into the future. We adopt a philosophy that is primary as opposed to being derivative in nature. In other words, unlike other trading methodologies, we act off the clues contained in price alone, as opposed to any derivative measure that may or may not have a bearing on the way price unfolds, such as macro variables, policy settings, or fundamental value opinion. We believe that alternative methodologies are full of assumptive stances that may or may not come to fruition, and given our understanding of complexity, feel that these alternative methods simply cannot faithfully be used as a reliable method to predict a possible future outcome. There are just too many derivative variables to consider. The myriad way that these variables in isolation, or often in tandem, may impact a future price trajectory in terms of timing and extent of price movement simply makes a problem of projection using these derivative methods as intractable. While we recognise that economic factors do have a central role to play in driving longer-term price action, we feel that we can only understand this outcome from a position of hindsight. When trading, however, at the right-hand edge of the chart into an uncertain future, the myriad possible future paths that price could take is simply unfathomable in extent. So given this philosophical stance to trading, we are termed price followers as opposed to price predictors. And as price followers, we seek to find any underlying trending bias that may exist in the price data that has enduring potential into an uncertain future, and once we have found this bias and understand its overall direction, either long or short, we simply enter a trade and let that bias do its thing, with risk mitigation methods enveloping that underlying projection of bias to protect us from adverse price movements. And these adverse price movements may be simply random price movements that surround the overall underlying bias itself, or these adverse price movements may be attributed to a change in the underlying bias itself. Now, this deterministic bias in the time series is attributed to what is referred to as serially correlated variables or signals that exist in the overall time series. There is a correlated or dependent relationship that exists between discrete price values of a time series. Now remember, correlation does not necessarily imply causation, but with correlation there is a greater degree or a chance that there is an underlying causal relationship involved. This dependent relationship creates this underlying bias to the way future price action unfolds. On the other hand, we can also construct, for example, price trends from uncorrelated time series data purely from the way independent price values can be arranged in a time series. These may appear as a trending price series, but there is no causal relationship embedded in this arrangement. As a result, they have no enduring future trending potential. And these are referred to as stochastic or non-deterministic components of a time series, which are referred to as noise. Now clearly, as trend followers, we are seeking those enduring trending price series that have serial correlation embedded within them, which give rise to an underlying bias in the time series, and we colloquially refer to these as real trends. On the other hand, there are numerous examples of fake trends which simply arise from the way a price series is arranged. However, there is no underlying causal bias in that series, and the series is defined as being serially uncorrelated. To understand this concept called bias versus random noise, I thought I'd use an illustrative example to state what we mean. So I've created a spreadsheet to visually describe what we mean by fake trends and real trends. And you will see as you examine the return streams that it's almost impossible to visually distinguish between them. So I use a random walk process to develop my time series, and in this case I'm using 10,000 equal time intervals, and the price of an interval is equal to the price of the immediate prior interval with a random price variation added or subtracted to this prior price. This is a simplified version of a possible outcome arising from randomness in a real complex system, but is used for demonstration purposes. So here is a visual chart of price arising from a single possible random time series. It looks strikingly similar to a real line chart of historical price data of any liquid instrument. And in it you can see periods of apparent trending condition, such as here, here, or the entire sequence here is a trending condition. And you can see periods of sideways congestion, such as between this zone here, or periods of mean reversion. Also within it you can see familiar patterns you might be aware of in technical analysis, such as head and shoulder patterns. We see head and shoulder formations up here. We see support and resistance possibilities within this chart. In fact, any form of technical pattern you can clearly see exists actually in a random time series. So let's run this random time series again, and we'll have a look at a few more examples. Here we have another random time series generated. Once again, periods of trending condition. This is very familiar to the time series you'd see in a normal chart, whether it's Forex, whether it's stocks or equities, whether it's commodities, you name it. Here's another which clearly shows a declining price series from random data. So as we're generating all of these different random series, you can see that the explicate form of this price series varies substantially, but it contains within it some of the very common features that we usually use, that we ascribe meaning to in our form of technical analysis. Now, the quandary faced by us traders is that we'd like to assume that there is some enduring substance in this price series that we can use to predict a possible future price direction. However, if the series is totally random, then this ability to predict a future is simply a game of chance. However, what needs to be understood is that trading a random price series in a game of chance leads to all manner of possible outcomes in the short term, some profitable and some not. So I've developed another spreadsheet to illustrate this feature. These are the equity curves of 30 different trading systems applied to the prior random series of price data. I have also applied compounding to the time series using the fixed fractional method of position sizing. But have a close look at the result over the course of 500 trades. There were some very good positive outcomes, and there were some horrid results that were rapidly approaching risk of ruin from the initial start of $1,000. Now you will note, if you look carefully at this array of return streams, that there is a slight asymmetry in this array. And this asymmetry is attributed to the method of position sizing deployed, where we risked 2% of equity per trade. So as equity declines, less risk is allocated per trade, but as equity builds, more risk is allocated per trade. This classic traditional risk sizing method offers some degree of capital protection as it progressively gets harder to meet risk of ruin as your equity balance declines. But the principle of compounding also serves to exponentially lift the entire curve when you have a positive expectancy over the course of your equity curve. But remember, these results were simply generated from a totally random series of market data. That is the nature of luck alone in action. You would think in this instance the 500 trades were sufficient to account for a degree of skill in your system, profitably navigating a price series. However, this is actually not the case with the random price series. To see an underlying edge unfold, you need a large sample size to deliver that verdict, and even with a large sample size, there never is a guarantee. For example, now let's look at the random equity curve arising from that same random market data, but over 2,000 trades. Here we are. You can still see some good results. And even up to 10,000 trades, let's go further. That example is with 5,000 trades. You still get very good equity curves with some of these options based on random underlying data. When you get up to 10,000 trades, it is still evident that there are some particular return streams that have done favourably based on this compounding method applied to fixed fractional position sizing. But the vast majority of return streams, we see a progressive exponential decline in their overall result as they approach zero equity. If we have a look at even the best return stream from this sample size of 10,000 trades on random data, we can see that we have lifted the equity from a position of $1,000 up to a position of $4,000 over the course of the 10,000 trades. But all these return streams were a result of simple lady luck. And now we're more than just gamblers at the casino. We want more than luck to decide our fortunes. We want a method that detects determinism in this market data and use a method that utilises that bias in the data to decide our future. If we can find that underlying bias in the data, then the miracles of compounding significantly amplify what we can achieve from luck alone. So now have a look at the red return stream from the same 10,000 trades that deploys an underlying bias in the data series. Where are those random return streams now, you might ask? Well, they're still there. But notice now how the scale of the y-axis is now in the millions. The compounded result of the return stream that traded the underlying bias swamped the random results over 10,000 trades. And what we see here is a system with an edge that attacks the underlying bias in the market data, as opposed to the explicate form of the market data itself. So here we are once again with our random series from our market data. So let's apply a small bias to the underlying market data, and we do this by simulating the presence of autocorrelation in the time series with a slight directional weighting applied to the time series. And here is the result. It still looks similar to the random market data chart, and visually it is almost impossible to distinguish between a random price series and a non-random price series with serial correlation present in it. And it has similar explicate form with similar features. This is why using traditional technical analysis is such a minefield for the trader, because it is so very difficult to ascertain whether the form itself has any forecasting potential. But when you put the random and non-random charts side by side, as we'll look at now, we can now clearly see the impact of bias on the series, and this bias becomes more overt over an increasing sample size. The bias is reflected by the difference between the two trajectories of the price series. So the bias relates to the difference in this zone here. Now, as quantitative traders, we are less concerned with the explicate form of the price series and far more concerned with the underlying bias of the time series, or the implicate underlying form that exerts an overall directional impact on the time series. And without having to get into complex data science, we can easily discriminate between the two by using sample size as our guiding principle for determining what is real versus what is fake. But without getting too cocky, we always need to appreciate the role that randomness plays in a return stream. So it is more prudent to say sample size is our preferred method to distinguish between what is more real and what is less real. After all, in the world of probabilities, there is never perfect certainty. So let's now get back to our equity curves and look at the impacts of bias. So let's first apply some trading costs to the underlying random price series and see the result. So here we have 500 trades, and within this series we have embedded some frictional drag associated with trading costs. Now, in the trade sample size of 500, you won't see visual evidence of this frictional drag, or it's very hard to see. However, as we now go to 2,000 trades, we start to see that there is a progressive presence of a frictional drag effect on the return series, where we start to see the return series mostly start trending in the downwards directory, reflecting the progressive impact of trading costs on the equity curve. And as we get to a sample size of 5,000, it becomes visually more evident, that frictional drag, and it becomes quite acute at levels of 10,000. So what we have seen is that as sample size grows, so does the progressive impact of this negative underlying bias associated with trading costs. It certainly was not clearly evident with 500 trades, but becomes obvious as the trade sample increases. This is just like the principle of detecting a biased coin from a coin toss experiment. With a few flips, the bias won't be evident in a sequence of heads or tails that arises, but over a greater sample size of flips, the bias becomes more overt in the data. So clearly, given that trading costs apply a frictional drag to the overall result, we want to ensure that any positive bias in the price series exceeds this frictional drag. So let's now apply a bias to the time series for a single return stream and observe a result. So we plot the random equity curves against a single equity curve highlighted in red that can be attributed to a system with an edge, namely a system that exploits the underlying bias that exists in a data series that is not random. In this example, the positive bias of the system's edge slightly exceeds the negative bias associated with trading costs. But as we can see in our 500 trade example, we cannot visually detect that there is an edge present in that red return stream. However, as the sample size increases and the story unfolds, we can see the impact of the bias exerting itself and the effect of compounding, amplifying this result over the large trade sample. So let's move to a greater sample size. Here we have 2,000 trades. We can slowly visually see that there might be an impact being exerted with the return stream with the bias, as it is starting to float to the top of the array of return streams, or other random return streams. As we get to 5,000 trade sample size, we can see how the system with the edge is starting to considerably outperform the systems applied to the random market data. In this case, we're getting the impact of not only the edge being expressed by the system, but the impact of compounding on that return stream, starting to exponentially push that system's equity curve with an edge away from the other random return streams. And when we get to 10,000 trades, we see a very pronounced impact of that system with the edge. Here we can clearly see that there is a definitive bias in the underlying market data, which is expressed by the system performance. So in summary, what needs to be noted is that we are not concerned with the explicit form of the price series itself, but we are concerned with any deterministic bias that may exist in the underlying or implicit order of the time series. This feature of bias is present with both price mean reversion and price divergence. However, being simple trend following folk, we are simply concerned with one type of serially correlated price series, and that is a price series in which a persistent divergent serial correlation is present. We simply follow price, my friends, because within that riddle of price may lie a kernel of truth. within the overall direction of prices wanderings. So cheers guys, we hope you enjoyed this video. Trade well and prosper.